That would be your swing trade. What you have to be accepting of on a swing trade is we could trade 69 to 74 and then come back and stop you out at 65. That's going to be uncomfortable. You're not going to enjoy seeing basically giving up 100 ticks. This is something that I ran through end of last week with the people who are on the current 6-week course. And we ran through looking at gold move. And this was looking at the move down and then back up, this kind of V reversal almost. And the reason we looked at this is a couple of people said, oh, well, you know, how could I have got onto this? And people who got in, they're like, oh, if only I'd held it for this. And I thought, well, let's go and look at the reality of this. Because in hindsight, these types of trades are easy. Yeah, you buy it down here, you play it all the way back up there. Absolutely brilliant. But let's go and look at the reality of it. If you look at the chart on the right, this is a 1-minute chart of this move. As the market drops, what you're effectively doing here is trying to catch a falling knife. The market's dropping. You're trading around 62, which is just around about here on the 15-minute chart. If you're buying that, the problem you have here, and this could turn into a spectacular trade. Indeed, it does. And it reverses all the way back up to around about this 83 area and then all the way back to 88, these previous lows as well. Absolutely great. But at this point in time, you don't have sufficient information. You're effectively trying to catch this falling knife. There's no real way of playing a scalp. There's no way of knowing how far down this is going to go. Might it stop at this VPOC? Might it stop at the bottom of the range? Might this be a continuation? So we've got a lot of unknowns. This then puts you in a situation where any attempt to play a bounce here, you look from a probability perspective, I'm looking at this thinking this is a 10% chance trade. You're effectively trying to guess the low and hoping that you actually get this one right. So this is where you have to step back. This is neither a swing nor a scalp. There is nothing you can do here. Now you get a little bit more information. This is the moment where you can think, okay, now I can do something. What we've got here then is delta reversal off the low. In fact, but what you can see down here is delta jumps. Now, when delta jumps, this is showing that buyers are now starting to step in. If you think that this is the low, this could well be. For a scalp perspective, this is an opportunity. If you can get in down towards 60, the bottom of this little range here, you can play back to this low at 69 and possibly even to 74. But that would be what I'm looking for. 67 and 69 as your quick scalp trade. You've got enough information from the delta reversal to expect a bounce. This is where as a swing trade, you can get in, but we don't have clarity. What I mean by that is we don't know that this is now a reversal. This could well be just a bounce before a continuation. If you're playing it as a scalp, that's fine. You can play the bounce from 60 to 67 and 69. You're in, you're out, you're done. If you're playing this as a swing, though, you've got to get your stop below the low. And really, until you get back out of this range over here, back above 70, and so by then implication 74, we're not on a reversal. This is just purely a bounce until you get beyond those points. So if you're playing this as a swing, you can do it, but this is a complete 50-50 trade here. It might work, it might not, and I don't think there's anything to say it's more likely to do one or the other. The scalp trade, though, with the delta jump, with the drop, and then the small consolidation, I would lean this towards being a 70% chance. This is a trade you want to take. You're going to take this. It's got a nice risk reward, and you look for that quick little movement in, out, job done. On the back of that, then, now that you have got that, and we have now got the move up towards 69, and this is important. People often think that scalping has to be quick. Yes, ideally it's quick, but you're playing it to the next reference point, right? And if 69.2 is your next reference point, you don't get out before there. Just because we're not moving a great deal doesn't mean that this isn't a scalp still. You're playing from one point to the next, that's still a scalp. On top of this, you now have the opportunity to buy the top of this little range here for a further scalp to 69 and 74. So you can actually add on to this scalp. If you're looking at this as a swing trade though, your targets are still all the way up here. You're still looking towards this low which comes in at 85 and then this level over here which comes in at 88. So we've got lots and lots and lots of space, and you are very much at the point where the swing trade is still in a 50-50 in the sense that we could bounce off 69. This could be the beginning of a flag and we actually roll over towards the downside. The scalp trade as well, if you're going to try and scalp from 69 to 74 there, that is also 50-50 until you're above 69. Get above 69, the probabilities jump. As soon as you're above 69, that's your chance. Play that next leg of the move. So a point here being that if you're scalping, you've had 2 or 3 chances here. You could buy it from down at 60. You can have a go at buying at 66. You can have a go at buying the break of 69, all of which are trades that are entirely viable, and you can have a clear stop on these. What I'll do when we look at the bear trap next week is I'll actually talk you through precisely how I would manage a stop on these types of trades as well. Once we've now got above 69, the reversal is now on. This is no longer a flag on the downside. You've in fact got a little bit of a flag to the upside. So we're now in a position where you can take this trade on, buying 69, playing forward towards 74. Nice straightforward scalp. You've got now a flag to play from. You've got clear target. You've got clear stop down at 66. All is good here. And you can play that trade. This is where the FOMO could come in though, because as a swing trade, you could also play the same trade from 69. If you break 74, this is good now to try and play for the full move back up. So the risk reward is really good here. You can play long from 69, stop down maybe 65 area, and you're looking to try and play all the way to 88. So that's a just shy of 200 tick move in gold. That would be your swing trade. What you have to be accepting of on a swing trade is we could trade 69 to 74 and then come back and stop you out at 65. That's going to be uncomfortable. You're not going to enjoy seeing basically giving up 100 ticks. The scalp trade, you're going to be in, you're going to be out and looking for your next trade. In both scenarios, both trades are attractive. You could play the scalp, which I think is probably about an 80% chance here. You could play the swing trade, which I think is 60%. A good swing trader can also be a scalper. And what you could do here is you could play the trade with double size. Half the size is a scalp to 74. Half the size is a swing to 88. That's the other approach towards the way you take this trade on. Finally, once you're above 74, now the direction is absolutely nailed. As a scalper, you've still got opportunity here. You can still try and buy the pullback to 74. You could buy the pullback to, 77 and 74. And now your scalp trade is essentially a swing trade. That your next move is 85 and 88. As a swing trader, your next move is 85 and 88. To play it all the way through the range, I think this is where you can make a mistake. This one works perfectly. Did you have enough information in this situation to try and play the full move through the range? I don't think you do. So in that respect, you then play it to 88. As a swing, 88 is your target. As a scalp, 88 is your target. 88 being the origin of the drop just in here. That would be your target on it, irrespective of which one you are. Now, this is a situation where I think the reversal looks pretty nailed on. So quite simply, now your objective is find your entry and play it straight the way up. This is the sort of combination of scalping and swinging. You can take multiple scalps up this move, and as time goes by, as the move progresses, you start to realize that this could well be the swing towards the upside. This is where even as a scalper, you can look for some larger movements. As a swing trader, The origin of the trade down here is hard. This is the area where you are going to have to accept that maybe you're not going to get the chance to act, or sorry, maybe you're not actually going to see this do the full reverse. It might hit a resistance and continue down. But as a swing trader, this is where your greatest payouts coming from. And this is my point on that uncertainty around what the likelihood of the trade working is and what needs to happen for the trade to work, the incomplete information, versus scalper, who is going on more complete information, which is just simply, if we break this area, we're going to the next area. So it's just one move to the next point. That's a real distinction between the two, but it's also how you can combine the two, which is a crucial skill. And really, we don't have out and out scalpers and out and out swing traders. We have people who are a combination of both. And it's the degree to which you use perhaps scalping more so than swing trading, the degree to which you swing trade more than scalp trade. That's the distinction, but everyone's got both skills in them. It's just the degree to which they use them.